The Bollinger Band. Bollinger Bands are an indicator of volatility. They are based on the correlation between the normal distribution and the evolution of a share value. As a result, Bollinger Bands can be used to draw a support curve and a resistance curve that will frame the evolution of a share value. Let's see the normal distribution definition. The normal distribution is a probability distribution that describes the fact that value evolve between -2 multiplied to the standard deviation and +2 multiplied to the standard deviation of the average for 95% of the time. The value will exceed this fluctuation for only 5% of the time. So you can see here the formula. Double M is the selected moving average. Example, simple moving average or exponential moving average, usually over a period of 20 sessions. It's easy to see here. The outer curves in red and green represent the drawing of a support curve and a resistance curve. So, a support curve for the green and a resistance curve for the red. They are at +2 multiplied to the standard deviation of the moving average and -2 multiplied to the standard deviation of the moving average. They represent therefore the Bollinger Bands. In orange, you will just find the moving average used to calculate the Bollinger Band. The distance between the Bollinger Band is more or less consistent as the price moves. This widening or narrowing of the Bollinger Band is a consequence of the volatility of the stock. The more volatile the stock, the bigger the standard deviation is, the more distant the Bollinger Bands will be. On the contrary, if the value becomes less volatile, we see that the Bollinger Bands become narrower. The crossing of the price with one of the Bollinger Bands reflects a pattern of either buying for the high band junction and selling for the low band junction. It also indicates a probable period of overvaluation or undervaluation of an asset. In this case, a market correction could be expected. At the end of March, we observed that the price of General Motors briefly crossed the high Bollinger Band, which means that the price is probably overvalued. As we know, according to the definition of a normal distribution, the price will exceed the moving average plus or -2 multiplied to the standard deviation only 5% of the time. Therefore, these negative signals indicates either a bullish trend or a probable market correction. Then, from the 1st April to April 4, the General Motors share price and the Bollinger low bands move together without crossing each other. This indicates that we are facing a strong downward trend. So, sudden that the price is on the verge of being undervalued. Finally, on April 5, we note at the same time the crossing of the price with the lower support band and the narrowing of the Bollinger Bands. This can be seen as a positive signals. Indeed, this signal is confirmed from April 6 with a market rebound, an upward correction of the price. We are experiencing almost the same phenomenon in the opposite direction, with the exception that the Bollinger Bands tend to widen over time. The first crossing of the General Motor price with the resistance band does not necessarily describe the sales signal, but the fact that we are therefore within a strong uptrend. When on April 10, General Motors price crossed the resistance band as a result of the Bollinger Band narrowing, this moment confirms the long negative signals. You have now understood how to spot potential signal by placing the price against the Bollinger Bands. Also, you have noticed that the thickness of Bollinger Band is important. It can be an element that will confirm a signal. In order to verify this signal alone, only the closeness of the price to one of the Bollinger Bands due to the narrowing of the Bollinger Bands, we typically have the situation on May 4. Without crossing each other, we observe that the General Motors price tend to move closer to the support band due to the narrowing of the band. In conclusion, it was a positive signal. Signal interpretation and identification from the Bollinger Band. Standard deviation and volatility. As we have seen, the expansion or contraction of the Bollinger Bands is a consequence of the value volatility. Indeed, the more volatile the values are, the higher the standard deviation will be. Conversely, if the value becomes less volatile, we will see a contraction of the band as a result of the standard deviation becoming smaller. Support and resistance crossing. The junction of the moving average with one of the Bollinger Bands reflect a trend, either buying for the junction with a higher band or selling for the junction with the lower band. This does not necessarily represent a signal. On the other hand, crossing a Bollinger Band probably signals a period of over or undervaluation of an asset. In this case, a market correction could be expected. It should be noted that the usage of support and resistance term to define Bollinger Bands is more relevant to a situation of low volatility,